Hey everyone, in this video I wanted to talk a little bit about what's going on with Plug Power stock. The company has seen its share price fall 30% in the last month, so I know that's got a lot of investors asking, what's going on? Why is this happening? So let's take a brief insight into the company's latest earnings call where management highlighted some of the major things that are going on so that we get some more information on the company. So Plug generated a $10 million increase in gross margin dollars during its latest quarter, attributed to the provisions promoting American made products under the IRA, the Inflation Reduction Act. So that's really nice for Plug investors and for the company that it's starting to see the benefits, and the company saying the IRA is starting to pay dividends to Plug. So they're starting to get the money that, that infrastructure package, that Inflation Reduction Act promised to give them. It takes time for that money to actually start rolling out from the time the legislation gets passed. So it's finally the time for companies like Plug to start getting the money that was promised under the Inflation Reduction Act, and that's been good news. Also, Plug is in the final stages of the second round of due diligence with the DOE, Department of Energy Loan Program Office for $1 billion project financing facilities. That would be good news for Plug if it can secure this deal. It's estimated that the loan terms coming from the DOE would be better than the company can get in the private market, but also this is a way for Plug to raise capital, raise money for its many investments that it needs to make, but also do it without diluting shareholders. So this could be solid if the company can indeed secure this deal for $1 billion in financing. Because the company's got grand ambitions to roll out manufacturing plant after plant of producing their green energy. So their hydrogen play in Georgia, which they are going to host an investor day on August 23rd, stands as the largest green hydrogen plant in North America. And I think it's important for Plug Power to open this up to investors, to experts, so that they can go in there and inspect and see what the company has going on, check under the hood, kick the tires around to determine how far along it is in this project, and so they can make decisions based on what they see there, because this is a company that's really ramping up their facilities, and investors don't have the information, the data in terms of revenue and profit and those traditional figures, so they have to go off of these technical figures, these physical tangible evidence to see, what this company's prospects could be and make a decision on valuing this company. Management goes on to say, excluding one time charges, their gross margins in the second quarter would have been minus 12%, and it would have been 20% better than the first quarter. So they will have seen progress from the first quarter to the second quarter if you excluded these one times items, which I'm not a fan of doing. I'm not a fan of granting companies exclusions and saying, oh, this is just, going to happen once and it's not going to happen again. I'm not a fan of doing that. If you took a one time charge, I'm holding you accountable for that one time charge. This likely means that you incurred some kind of expense to your business, or maybe you invested, let's say, $50 million for this manufacturing plant that didn't turn out as you thought, and now you have to write that down from 50 million to 40 million and take a $10 million hit. I'm not going to grant you an exclusion and say, oh, that's okay because it's just going to happen that one time. No, it's probably not. If you've made decisions like that in the past that have led to one time charges, it's likely that you're going to make decisions like that again in the future that are going to lead to these kinds of charges. So I'm not going to grant you this exclusion and say, oh, okay, it's just a one time thing. Let me take that out and count your results without that, right? So I'm not a fan of doing that, but management likes to try to get you to do those types of things, and I'm not singling out Plug Power here. Nearly all companies, nearly all management teams will try and get you to look at and ignore these types of items and look at their figures in a way they want you to look at the figures. So throughout the rest of 2023, we will see continual margin expansion, and that's great news. And that's the company has delivered that over the years, and they have said as they source more of their production in-house, their cost of the material is going to go down, and thereby it's going to expand profit margins. So the more of these hydrogen plants they bring online, the Georgia one being the one that's closest to coming fully online, and they've got plans for more after that, the more they bring those online, the lower their costs are going to be, and therefore the higher their margins are going to be, because they're paying a higher price to get these from third-party resources. And so if they bring it in-house, it's going to lower their cost. So overall, we've got some good insight here into what's going on with Plug Power. The big things being the DOE loan program for $1 billion financing. That can be a huge benefit for the company. And the next thing is the hydrogen plant in Georgia, getting that online. But I think the bigger deal is this DOE loan program, which the company said they'll get a decision on by the end of this year. So something, in the next few months, a decision will come out from that. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.